I'm trying to play catch up on all the prior conversations. So you'll see some of these evergreen conversations on Spotify and Amazon Music and Apple Podcasts. My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is the Shrub himself, the Shrub. So I know you want to stay anonymous, but to the extent that you're comfortable, talk about who you are, how'd you get involved in markets, what are some of the things you've done in your career, and what do you do now?
Yeah, sure. So before I was a Twitter parody account, I actually was a hedge fund manager. I started in investment banking. Then I spent 16 years in hedge funds. The first 5, I had a great mentor who became very famous by shorting the US housing market in 2006 to 2009. There I spent a lot of my time in financials and commodities. It was a great learning experience. Then I became a portfolio manager at a hedge fund. And now I run a family office out of Monaco. And in my spare time, in my full-time job, I tweet, and in my spare time, I run a family office. So basically, I have one outside client and then my own capital as well.
All right, let's talk a little bit. Sorry, go ahead.
Yeah, sure. And my background was in event-driven investing, so that's why I approach everything as an event-driven trade. I'm not a macro. I evolved into something else, but that's my background. It was actually merger arbitrage and spin-offs and all that. So I basically I lost money in pretty much every asset class out there. So that's why I feel comfortable sometimes taking various trades.
You truly were a hedge fund manager if you lost money in every asset class.
I lost in every, yeah. So I still do.
Well, and by the way, can I just say, that's okay. I mean, everyone loses money. It's like the FinTwit side of things is absolutely absurd in the way that people that are going through a hard time in a drawdown get vilified in a small sample, not judging their process, but judging their outcome, which we'll talk about. But let's talk a little bit about the hedge fund side of your experience and the transition to your own family office. I'm sure you've seen these studies, just like a lot of people have, this idea that alpha has been basically negative when you look at active hedge fund strategies compared to pre-GFC. Talk about what's happened with the hedge fund community from your vantage point. Why is it that these anomalies that all these hedge funds were supposedly taking advantage of now seemingly either don't exist or maybe have been fully arbitraged away, and now it's all about cheap beta?
Yeah, I mean, look, when I started, which wasn't that long ago, so I started in 2006 in the hedge fund industry. So you're much more familiar with how I was before. But even in 2006, which was a developed industry, we were one of the biggest merger arb funds, and we were running $1 billion. Elliott was our peer, and they were running a few billion. By the end of where I left my first hedge fund, we were running 40 billion, and Elliott is now running God knows how much. So around, probably more than that. So, and then you see someone like Tiger, Chase Coleman, a very respectable hedge fund manager. He started with 100 million, and now he's ended up running 100 billion. So, it's the law of, what you want to call it, the law of big numbers. So if you want to generate alpha, it's easier to generate alpha if you're nimble, unless you're Buffett and you have a very long-term approach. But if you have this monthly pressure, which used to be quarterly, now it's monthly, and sometimes it's weekly, then you want to be as small and nimble as possible, which is not the case. So that's the first thing. That's on the demand side. On the supply side, something else changed as well. The liquidity in the market has evaporated. So you can't really be as nimble as you used to be. So I remember trading $50 million in a UK bank in 2007. Right now, you're going to trade a fraction of that. So the liquidity has evaporated and doesn't allow people to be more as flexible as they should be for their strategy. So that's why I'm kind of enjoying stepping back from the big capital, running a big pool of capital and a smaller, nimble pool of capital, because it actually allows me to be flexible, especially when you have a small team. I am my own team, so that makes it easier for me to be flexible. Now, someone like Chase Coleman, once he was on the wrong side of the trade, he's stuck in it. And funnily enough, the way he was trying to generate alpha was by going private, so going even more illiquid. I'm not blaming on him. I'm just saying that it was also a trend in the industry. They were like, oh my God, my portfolio is too volatile. What do I do to reduce volatility given there's no liquidity in the market? Well, one way I do that is I just become more illiquid and I go private. So, the industry, unfortunately, was focused too much on AUM growth instead of performance. And this is why this is happening. I mean, just to give the bright spot of the industry, places like Citadel and Point72 and Millennium are doing actually extremely well because they have small pools of capital competing against each other. So bizarrely, these behemoths are actually doing okay by replicating how hedge funds used to be to a degree. But people shouldn't underestimate the pressure that hedge fund managers are in because, we like to make fun of them. We like to make fun of hedge fund managers. All these monkeys are on the same trade and they're all short and they're all long and this and that. But, but actually the constraints that a modern hedge fund manager lives under are immense. They have to be market neutral or deviate by 10%. Like at our last fund, you couldn't deviate by more than 10% on your net exposure. So to generate alpha while you can't have direction or you have strict liquidity limits, it's very difficult. Now, a smaller investor and a retail investor, if he's aware of these things, he can actually make a lot of money. So there's both sides of the coin. In the hedge funds constraints, we actually find opportunity by just playing against those constraints.
So let's keep going with this because I'm glad you mentioned this. It's not that we're going to defend hedge fund managers or any managers in general, but that point about flexibility and the pressure is an important one because as much as everyone believes that whether you're a portfolio manager of an ETF or mutual fund or a hedge fund manager, that these people are all wildly wealthy and that they're all full of shit in the way they approach markets. But the reality is there are many that are entrepreneurs trying to offer something that's different. But in offering something that's different, to your point, they may not be as flexible as a retail investor. And flexibility is an interesting term because it relates a lot to opportunity set. Right. The idea is that you can switch around different asset classes, different sectors. You have freedom to do so. Again, you may not be able to do so if you're running an actual fund with other clients. Interestingly enough, though, and I want to hear your thoughts on this, I'd argue that being flexible in terms of having a wide opportunity set has actually been damaging over the last decade. And I say that because really most momentum was focused around just the S&P, US, large cap, beta, cheap beta. I want you to talk about from the hedge fund perspective and from your own family office perspective, how do you think about where to focus your attention on where to invest? Because a lot of that has to do with cycles, and cycles are notoriously difficult to predict.
Absolutely. So, Michael, the important thing about, and that's why I actually really like the active ETFs space, because they actually do what they say on the tin. I know people like to dunk on Kathy, for example, but actually she does what it says on the tin. And if you want to redeem, you sell on the same day. That's fine, right? Whereas you have a Tiger, and again, I don't want to diss on Tiger, I'm just using the comparison. Tiger, if you want to redeem now, it's going to take you a few years. So the industry, I think, has evolved, into the active ETF industry has allowed the industry to be a bit more, to increase the offering and also just increase the liquidity of the asset class. Now, when I look to invest, and the problem with giving people too much choice, of course, is exactly what you said. Like if you give them too much flexibility, they will sell things at the lows and they will buy things at the highs. But again, going back to Tiger, and I hate using Tiger so much, but the guy sold Carvana at the lows. So sometimes we say we're going to give our money to an active manager, lock it up for 5 years, but the active manager doesn't do what we say. So that's why people should spend time to educate themselves. And I think FinTwit is a great platform which allows people to educate themselves and seize opportunities. Like the way I invest is I want to have, I approach the market as a special situation, as an event trade by itself. So I want to lay out the current setup and I want to see where, which areas have momentum, but also because I come from a fundamental background, I want to have momentum and some fundamental backing. So, it's very important for me to know under what regime I am. So, for example, now, I just tweeted out in October 2021, I said we're in a stagflationary regime and we're going to be in this for a while. And, I think we're still in a stagflationary regime and we're going to be this in a while. So I go back and I see what worked out in the last stagflationary regime, which was the 70s. And I had this chart, which I kept on my desk for a few years, knowing one day it could be helpful. And, lo and behold, the best performing sector was energy and then value and then real estate. And the worst performing was tech. So my portfolio was skewed towards energy and real assets and short tech. Bizarrely, my portfolio is still the same, but a bit less invested during the summer. actually a lot less invested. So I'm less than I'm less than 50% invested. I'm actually 35% invested. But it is a very tricky market environment. And that's why I like to, I have this inherent philosophy, which I jokingly call it KISS, keep it simple, Shrub, where I basically just try and keep things very simple so I don't torture my mind about what regime I am and how things are changed. So, for example, I think it's stagflation. This is my regime. I'm sticking to my regime. So I've actually just written down two data points for every theme out there that I can just go through if you want now to describe the market setup, or we can do it later. Up to you.
Yeah, we'll get to that. And again, I want to get to some of the audience. There's one thing I want to just hit on, which you mentioned Cathie Wood and FinTwit. And I think, in fairness, the issue that I see myself on Twitter, and particularly on the Fin side of things, is there's not a clear separation of the person from the problem, right? So everyone will rag on Cathie Wood, but she's doing what she's supposed to be doing. That's her perspective. That's her mandate to invest in. Whether you agree with it or not, that's what she designed. That's what she created. She's the woman in the arena. I think a lot of the criticism, which I do believe is justified, is not necessarily on Cathie per se, but rather journalists and the way that the media makes it out that this person is the innovator that everyone has to pay attention to. This kind of glorification of gurus as opposed to cycles the gurus are operating in. And, I've used that line quite a bit. There are no gurus, there are only cycles. That, I think, is very toxic, right? Because if it's constantly about the individual as opposed to the why their strategy isn't performing well, you never really learn very much. But unless you understand the why, the attribution, you can't really make a judgment if the person is wrong in launching that venture, launching that strategy, creating that hedge fund, creating that mutual fund, that ETF, or if it's just a function of the wrong cycle that strategy was launched in.
Yeah, absolutely. I mean, this industry, we love to create idols and then destroy them. There's also a lot of jealousy in it. And it's very easy to dunk on people that, lose money or make a wrong call. I mean, the funny part is, when I tweet out and everything I tweet is free, and yet I get dunked when I make a mistake once in a while or quite often. Like, well, dude, I mean, I gave it to you for free. So my advice or my lack of advice is worth what you paid for. So, but besides that, it's worth just staying on the mindset 1 second, because it's been a very tough year and I think it's going to get worse. And I think it's just very important to mention this thing. The market I see it like an arena, like the Colosseum. And we're all gladiators in the Colosseum, and we just have to come out alive. And you have to respect everyone who plays the game. You have to respect everyone, either the losers and the winners. You have to respect them, but also you have to keep a very positive mindset. So I don't know if you noticed, but I was offside on my tech short for the last week or so. So I was sending photos of a donut that I placed around. I was placing a photo of a donut around the town and taking photos of it like it was my pet. Just personifying my loss as a donut, kind of just to make fun of my loss. But small things like that is just improves your mindset, because a loss is a loss, but you still have you should be aiming to have your health and your family first, and then deal with the losses, which are going to be many. I mean, there's going to be many losses in this game, and it's just a question of being positive and coming back. But the toxicity of Finch, obviously, and the world, by the way, makes it worse, and that's why you have to find ways to make it better. And that's why I actually enjoy having these discussions, because I always want to raise this point. Mental health and positivity is very, very important in this game. If you're not feeling up for it, or your mental state is down, or you're down 30%, or you put your money on a stupid thing and you lost, well, you have to step back and improve your mental state before you get back. Because at the end of the day, it's only, it's a very long game. It's a very long game, and it's a marathon. I know it's very cliche, but it's a marathon, not a sprint. But it's very true. That's how it should be approached, and it should be approached with like it's fun, because it's fun. I mean, I love doing what I'm doing. I do it for free. Kind of did it for free for a while. But if you want to talk about something, like I blew up an account once. That wasn't fun at the time, but that blow up taught me so much 10 years later that it prevented me from blowing up another 10 times after that. So, it's an arena. We're fighters in it, and we have to keep learning. And, if we help each other along the way, it's even better, right?
Well, yeah, which is missed, because unfortunately a lot of people think it's a competition when it really shouldn't be about that. One quick point about that marathon versus sprint argument. When you're I'd argue when you're at family office and when you don't have the pressure of clients who are seeing a data point with just their smartphone real time, it's easier to have the mindset of this is a marathon, not a sprint. Whereas you're on an ETF, you're on a mutual fund, you're mark to market daily, or in the case of ETF, second by second, then it can very much feel like a sprint because the challenge of trying to keep investors in a strategy longer term, especially when you're in a drawdown shorter term, right? And that's which we'll tease that out because I think that relates directly to that.
Yeah, I had that problem a lot when I was in the merger arb fund, because merger arb it's a very boring strategy. I'll give the 30-second download.
And very spotty, right? Exactly.
Yeah, exactly. So you try to make, like, we were trying to make 10% a year when rates were 2%. Then we're trying to make 6% a year when rates were at zero. And 6%. There's nothing sexy about 6%, except the fact that if you get a deal wrong, that 6% becomes zero or negative. So, those discussions, in the merger arbitrage space, I've seen it happen, by the way, where, they ask you to be, if you're optimistic and you say, well, there's not much deal flow right now, so not really. But they tell you, yeah, but can you do 6%? And he's like, well, probably not this year unless I put more leverage. It's like, well, why do you put more leverage? And that's why you see a lot of blowups in the merger arb space, because when there's a small opportunity set, people actually put leverage on their deals. So when the blow up happens, it's even more spectacular. And actually, the worst kind of, like some pretty bad blow ups I've seen was because of investors demanding a change of strategy or advice. There's one book, the name was, it was a diary of a hedge fund manager. And, he was conservative and his clients told him to become more aggressive. And this was 2008. And then the guy blew up because his clients told him to lever up. So it's really, really difficult to stay true to what you want and to your mandate. Sometimes the mandate is really, sometimes the mandate is not sexy or attractive. And I've lived through it. Like, I've had years of nothing. I had a couple of years where I had literally nothing interesting to do because I was sticking to the event-driven side. And it's just a question of not doing anything stupid in that period. So, if you're trading merger arbitrage this year, you would have had so many landmines with Twitter and a few other things that blew up. So, it's very difficult for people to stay disciplined and keep their investors happy. And again, from my perspective, being an outsider to this, I look for opportunities when people do mistakes like that. So, for example, the Twitter saga was a classic example where the merger arbitrage guys did a mistake. When Elon pulled out of the deal and the stock collapsed at 33.60 from 44, I think it went down to 33 because he pulled out of the deal. The merger arb guys were liquidated. And that point I tweeted out that I'm buying Twitter because, nothing's changed. The guy has to go through the court case and maybe close the deal. But what I'm trying to say is, because of the market setup and how participants are positioned, you can also spot opportunities. You feel sorry for the guys on the other side, but you have to seize opportunities if you're flexible enough to do it. If you're not, then you have to wait. But being bored in this industry is very, very dangerous. And unfortunately, as someone who was running a European book, man, Europe was a cemetery for years. It was not as bad as Japan, but it was pretty bad after the crisis. And unfortunately, I think we're heading towards that scenario again, but that's a different story.
Yeah, and we'll get into that. I think that's a good transition. So let's talk about the KISS for a moment. Keep it simple, Shrub. I'm a huge fan of simplicity. I'm a big fan of focus on one or two variables that might explain 50, 60% of why markets do what they do and accept the truth that the rest is randomness, then try to curve fit and chase optimization. So having said that, when you talk about keeping it simple from your own vantage point, from the family office side of things, what in your view is the current setup and where are people maybe overcomplicating their own perception of the here and now?
So look, before I joined the call, I thought I'll just sit down and think about 2 data points for every important geography or every important topic, just to make it simple and see where we are. And then we just reach a conclusion at the end. So without further ado, so my topics were Europe, US, China, positioning, and technicals. And I have 2 data points for each one of them. So let's start with Europe. So the first data point in Europe that you had a great spaces with Alex on this one The German baseload price went from 40 megawatt hours before the pandemic to 660 megawatt hours. So that's data point number one. So given the German industry is 30% of GDP, that obviously spells a depression for Germany and Europe, because that's a 12% hit to GDP. So it was estimated to be 12% hit to GDP in Germany is like a $400 billion. That's half a Tesla. So that's kind of real money. So that's data point number one. And actually, if you link to that the consumer in Europe, that's a 10% hit to consumer disposable income. So you have two very negative things. On one side, you have a hit on the industry. On the other side, you have the consumer getting hit by 10%, which is meaningful, means some people are going to buy less iPhones. The second data point is the Italian 10-year. The Italian 10-year is at 3.75%. And then we have elections in September. And funnily enough, the party that's leading is a hard right party. The lady is called Meloni. And even though it's a lady, she leads a party that's called the Brothers of Italy. So that's like it's like a complete joke. She's leading a party called Brothers of Italy, and she's a lady. Go figure. Important thing is Italy 10-year 3.75% with a hard right coming in. I think we could be, we could be risking another sovereign crisis in Europe if you put everything together. So that's Europe. Not very bright, but my view was we're going to have stagflation in Europe. The energy situation is looking bad, and it's going to get worse. So, for example, one thing that no one talks about, we're all focusing about this winter, but what about next winter? So, let's keep it simple. Like I had this revelation today, just sitting down to think about these spaces. And I'm like, well, hold on. So we're storing gas for now, we're storing coal for now, but next winter we're screwed because we're going to use up everything we have. So, the Russians came out and said today that they're not willing to negotiate about Ukraine. So obviously the setup is going to stay bad. I think the setup is going to stay bad for 2-3 years. So, and actually the Belgian prime minister said that we could have 10 bad winters. The reason why I'm highlighting this is because we see some trades as transitory, and they could not be. Maybe they're not transitory. So maybe the energy trade is not transitory. So that's Europe.
Oh, before we continue with that, I want to expand a little bit on that, because this point about sovereign debt crisis, I've been myself seeing that for the last several months, that the way the dollar is behaving, it's almost as if it's anticipating some kind of sovereign debt crisis, right? Because
absolutely,
historically, when you have, if you want to see sort of the whites of the eyes of a sovereign debt crisis, you first see it in volatility in currencies, which is, I think, what's happening with not just Europe, but also obviously Japan with the yen. But it sounds to me, and correct me if I'm wrong on this, and you're closer to this than I am, that you think that there's maybe a 2011 repeat, meaning that there's concerns again over the pigs and the blowing out of sovereign yields from there.
Absolutely. I think it could be worse, because right now we are in an inflationary environment. The ECB was very mistakenly kept rates at negative 50 bips for too long. We had negative 50 bip rates until last month. It's insane. It's insane. We have inflation more than 10%, producer prices through the roof, and we had negative rates. So, you wrote that song, Too Little, Too Late. And I was thinking, did you write that for the ECB?
So it's all shattered memories.
Exactly. So basically, Europe is in a big risk. And unfortunately, a very underreported fact, but the Europeans that follow this would know this, the Kremlin was financing a lot of European politicians. So, for example, they financed an Italian movement and they financed Le Pen in France. This is all public, by the way. They gave 10 million to Le Pen's campaign as a loan. So the Kremlin, and by the way, Gazprom was also financing an anti-nuclear NGO in Germany. Surprise, surprise. If, in case anyone is wondering why Germany is not restarting the nuclear. So unfortunately, I don't want to be the conspiracy theorist, but Russia has invested a lot to weaken Europe. And this is what's happening right now. And unless you see a cooperation on the energy side in Europe this winter, well, you're going to see this fragmentation. So, for example, imagine this Meloni lady gets elected and she starts doing an anti-German stance or anti-Europe stance. And then Germany says, well, why should the ECB be keeping the spreads tight if this woman is against us, and just lets the spreads go? Then we could have a bad winter from an energy price perspective, and we could have a bad winter from a spread perspective.
Well, that would be, by the way, a massive deflationary shock, right? It's like every sovereign debt crisis is inherently a deflationary shock to the system.
But the difference here is that we're in a stagflationary environment because the energy prices are going to stay high. So this is the paradox you have, and I agree with you. We should have a massive deflationary hit, but because the power prices will be high, you're not going to get that, because deflation is actually acting also like a dampener. Like, it's not necessarily a bad thing. If you have deflation, you're actually correcting prices. But you could have deflation in certain things, but actually inflation in heating bills. So I estimated, in the UK, for example, the average household income is £30,000. They were paying £1,200 a year on their electricity and heating, and now it's projected to hit almost 5,000. So, it's a fivefold increase, but that's a very, very big hit on their consumer behavior. So you're going to have pockets that will definitely have deflation. Well, much lower demand in certain things to support the purchase of, basics like electricity and heating.
Everybody, please make sure that you follow Shrub, who's not a scrub, from the beginning of the conversation. But let's continue with that. Okay, so you've got Europe. Let's talk about China, right?
Okay, so China, two data points. Youth unemployment at 20%. Second data point, real estate sales down 46% year on year in July, month on month in July. So real estate in China accounts for 30% of GDP, but also it accounts for 70% of wealth, because the Chinese, they don't buy stocks, they buy real estate. And at the same time, Chinese real estate also accounts for, 1/3 to 50% of global commodity demand in some cases, like copper, for example. So you have, in this case, you have a deflationary impact. I actually visited the ghost towns in China back in 2009-10, and it took about 12 years for this to become a real issue, it looks like. One interesting thing that I was reading is like 500,000 customers lost their deposits already, and you had these developers defaulting and you had banks defaulting. So the real estate sales down 46% is a very deflationary impact. And don't forget, this is the engine that bailed us out in 2008-9. It's one of the engines. So on one side, it was the Fed, but on the other side, it was the fiscal stimulus of China. And now we have a different effect. We have the property market just grinding to a halt, and it needs a lot to get going again, which it doesn't look like the Chinese are ready to do it, because they have other issues to deal with, one of them being inflation. Now, the first point I gave, which is youth unemployment at 20%, well, that's kind of like what we had in Italy and Greece. Actually, it was bigger back then in 2011. So what does youth unemployment lead to? It leads to, riots or disgruntlement, or might even lead to something, maybe the Chinese government ends up invading Taiwan as a fiscal stimulus at the end. It's not unthinkable. So that's China. The US, I think, is simpler. The US is actually the bright spot for me. And when I go long things, it's usually in the US. But it has two big problems. And I chose these two data points specifically. The first data point is that the US CPI is at 8.5%, but unemployment is 3.6%. So what this data point tells me is that the Fed, if they want to get to 2% inflation, they have a lot of space to tighten. Now, it's a good thing and a bad thing. I think the US labor market is actually very strong. And I think, the housing market is actually kind of okay. But if your inflation is sticky, then it means you have a lot of room to tighten. And we haven't seen the effect of QT yet. And I don't think, I think the credit market is too complacent as to what could happen. So that's data point one. Data point two is that the biggest stock in the stock market is Apple, which is at 2.7 trillion and on 25 times earnings. Now, last week when people were getting excited about a new bull market, well, I would struggle to call a bull market when the biggest stock in the market accounts for 7%, is on 25 times earnings and 2.7 trillion. Like, great company, guys, but I kind of don't really buy it. So that's the US. Now, on technicals, two data points that I had. We failed the 200-day moving average last week. That's the first data point. And the second data point, which is very, very simple, but people just underestimate this, is that the 200 DMA trend line is pointing down. Now, if you're a technical trader, well, the trend is down. It's like as simple as that. which takes me to positioning, which is one of my favorite topics, which is really misunderstood. So, every week I tweet out what the real money is doing based on the Bank of America survey. And every week I've been showing that there's been outflows in Europe, some outflows in credit, but inflows all the time in the US. And I think the conclusion was that for every $100 that were put in the stock market since January 2020, only $3 came out. So for every 100, only 3 came out. Yet, and in the bonds case, it was like for every 100 that came in, I think 25 or 35 came out. But the point is, I kept reading about bearish positioning. It's like, well, hold on, no, real money has been invested and it stayed invested. Now, the second data point on the positioning side is that the CTAs, the commercial specs are the biggest net short they've been for a while. So 260,000 contracts S&P. So I said on the first data point, which no one is quoting, that for every 100 that came in, 3 came out. And I said on the second data point that everyone is quoting that the market is the biggest net short it's been for a while. Well, the difference is that the stock market cap is about $50 trillion, $48 trillion to be exact. So when you're looking at the spec, so the hedge fund net short of the S&P, it's like, 50 billion. So that's why the pain trade is usually always down because if you have $50 trillion worth of wealth, then who cares if, the hedge funds are going to just mess around each other. It's what I call a pod-on-pod violence. Millennium goes long one day and 0.72 goes short the other day, whatever. So they just cancel each other out. And there's 50 billion net to cover and whatever. But in reality, the real thing people should be looking at is, there's 50 trillion worth of market cap. That if they decide to get out, if the Fed does something stupid, well, they're going to sell. They're not going to be waiting for the 50 billion to cover. So that brings me to why this setup is very, very strange. We have a Europe that's in stagflation. We have a US that's actually okay, but there's a lot of room to tighten. We have China that looks like it's going to pay its dues for all the mistakes of the past. We have positioning that's actually still kind of bullish in my book. And we have technicals that are bearish. And I mean, on the positioning, I remember in '08, people just liquidating everything, not because they wanted to, but because they had to. And I don't think we reached that point yet. And I was actually quite surprised by even Tiger selling stuff at the lows. I don't know why they did. I mean, they must have had some kind of redemptions. But, just putting all these things together, Michael, it's kind of an extreme list of bear porn in some ways. But this is why my positioning has been going lighter and lighter, especially given it's summer and liquidity is drying. I'm still net short. And as a caveat to the whole thing is, just so we don't get people too bared up, is how do you solve all these things? Well, the two things were always the result of such environments is you either have war or you have debasement and a print. So that's why it's very, very risky to be massively short after I gave you the most bearish speech I've done for a while. So.
No. And that relates to a line I keep saying, which is that bear markets make fools of bulls and bears. And what I'm really hitting on actually kind of goes back to your point around the 200-day moving average. I had a little bit of back and forth early in the morning, basically pointing out this what I believe is fact, that the 200-day moving average really doesn't tell you so much about trend, which is not a very popular opinion. It tells you about volatility. Oftentimes, when you're above a moving average, volatility is lower for whatever asset class you're looking at. You have more streaks in performance. And when you're below a 200-day moving average, it's more volatile. Most recessions tend to occur when you're already below the 200-day moving average. And the dilemma with shorting in a highly volatile environment is that it's very hard to do on a systematic basis. Yes, you might get some profits, on a declining market, but it's not about the direction as much as the back and forth seesaw that happens when you're in a volatile regime in a back and forth kind of environment like we may be re-entering. But I want to get some of the audience here. That was just more of a side note.
Oh, I'm
why is it Dogecoin? Be honest.
65% of my money is actually in US dollars, so that's an easy one. So thanks for that. Always great to speak to you. I just think the US is in the best position. The other countries I had some exposure to, where I had some Canadian and a bit of Australian, and actually have some euros here as well, because I live in the Euroland and I was structurally short for a long time in Europe. in euros, and now I have some, but the majority of my liquid portfolio is in the US dollar. And look, the US, I mean, you guys that live there, you're bearish because you see things are, maybe slowing down, but you should see how it is in Europe. So currencies are a relative game. And, the fact is, with all the problems, the US is still the best place around. You have energy independence, you have great companies, you have capitalism, and, it doesn't matter who's in the White House, right? Whereas we have a war next to us, we don't have energy, and we have a disunion of, countries that had their own currency 30 years ago. So that's why for now it's the US dollar. And at some point, it will be gold and, maybe Bitcoin at some point. But, personally, I've never bought Bitcoin. Stupid me. But I did own a lot of gold in 2008-9. I haven't gotten yet to the point that I want to buy gold, but I'm sure it's going to get there soon. And yeah, I need to spend the time on, digital currencies at some point, but I'm not that smart yet. I can only do so many things. That's why I just told myself I'm just staying out of that.
Well, so so at some point, what about treasuries? And I say that because, again, this is selfishly, I keep making this point, that what we saw this year has never happened before in history, in the drawdown in equities matching a drawdown in long duration treasuries, in particular, let's say TLT as the proxy, meaning that risk off, the safe haven, ended up being the same as risk on, which is frustrating because they've been more exposed in risk off position treasuries than not. The problem is that obviously it hasn't played out the way historically does. But do you think that treasuries at some point get back to that quote unquote safe haven status? I mean, presumably there's some yield where it gets to be really attractive for a disinflation pulse whenever it appears. But how do you think about treasuries in the context of the future here?
1,000,000%. And Michael, I think for me, treasuries, look, from a family office perspective, at some point, my dream trade would be to just park it all in treasuries. Whether it's at 3.2 or 4, I don't know. I'm waiting for my own signals because I think the Fed needs to tighten. I'm actually a bit anti-consensus that I think the Fed should tighten more. But there is a level that everyone is going to park their money in treasuries because it makes sense. And going back to the previous point, and I'll give you two stories, but going back to my previous point about Apple at 25% versus a US Treasury at 4%, I think people are going to be in US Treasuries at 4%. That's why I'm actually, keep, some strategic shorts in the market, because I think, certain asset classes are mispriced. But treasuries, let me tell you one very important thing, which I lived through in 2008. So I tweeted out at some time ago that 2022 was a worse year to invest than 2008.
Please say that for everybody in the back of the room. Because I've been making that back in February. I think I tweeted out saying this is more treacherous than 2020 and 2008.
It's much worse. It's much worse for real. For investors, I'm going to share the tweet. I've shared the tweet. It's worse. And in 2008, I mean, I traded 2008. I did pretty well in 2008. If you were, but that's because we were short subprime and we were short equities. But what I missed in 2008 was that if you were a 60-40 portfolio, you actually did pretty okay. And that's what, Bridgewater did pretty okay. So in 2008, the 10-year started at 4% and it finished at 2% because we had deflation. And we had a deflation environment. So you have the world's biggest asset class, the US Treasury market, and it provided a safe liquid hedge.
But by the way, one thing that gets missed in that, I'm glad you mentioned it, is that 2008 is an interesting story around sequence of returns, right? So when Lehman Brothers happened, treasuries didn't really rally in a big way. Yields didn't really drop. It was really basically the final hour. It was November, December, right? Where treasuries really had a huge 40% move, which means, by the way, that if you were risk on, risk off, and in the indices that it created, it proves this, you could have done terrible for the first 10 months of 2008, even being exposed to equities as Lehman was happening and as that crash took place. But if you happen to get that treasury trade at the end of the year, you pretty much could have made it all back, if not been positive.
Absolutely. And gold was the same thing, because I remember buying gold towards summer, Christmas 2008. But, look at the chart. I mean, on the tweet I put in, you look at the chart of the TLT versus the S&P, and it shows exactly what you're saying, that, TLT was flat, the S&P was getting destroyed. And then what happened? And this is, now I understand this after I lived through it. It took me 10 years to understand certain things. So the S&P was getting liquidated by real money, but it was just liquidation with no net addition. That's why the TLT was flat until November. And then suddenly you have all that cash sitting on your balance sheet, and you're like, well, what the hell do I do with it? Oh, they're going to cut rates, aren't they? Well, you pile it all into TLT. So that's why TLT had that massive run in 32%, whereas the S&P finished down 40%. And I see it now with other family offices and our own. As we're gathering liquidity in our balance sheet, well, that liquidity at some point, not going to say it's now or in 6 months, at some point that liquidity is going to get parked in treasuries. And then if you want to get the other slide is why 2022 was a disaster, is that we started at 1.6% with the 10-year. And we finished at 3.2%, but in an inflationary environment. So 2008, we had deflation. Now we had inflation. So the role of the hedge in 2022 was not the treasuries, it was energy. But energy is not that big of an asset class. So it's only like 4% of the S&P. So it's only like small fish like me that can use that hedge.
Right. What we saw this year, exactly to your right, that setup was, you've never seen it before, right? Where yields were at the all-time lows, equities were at those highs or near all-time lows on yields. Then they both broke down, right? Which is something that's not even happened in the 70s. And we can argue here tomorrow about the definition of black swan. It's not based on imagination. If the original analogy is all swans are white, and then all you need is one observation of a black swan to prove that not all swans are white, well, all extreme declines in equities have treasuries actually significantly outperforming, except this one.
Absolutely. And that's why I absolutely agree. And that's why I said 2022 for real money managers was a much worse year, because 2008, they could have protected themselves with the most liquid asset class, whereas this time round, the most liquid asset class was actually treacherous. Not only did it do nothing, it was down 20%. And by the way, brings me to the point, is there an opportunity in it? Yeah, there is. I'm not long yet, but if all the bad things play out, I give you a list of 5 categories with 2 data points for each one. So that's 10 really nasty data points. So if some of them play out together, well, there's going to be a flight to safety in treasuries at some point, as long as inflation gets tamed, which is the reason why I'm staying out of treasuries for now, which is going to change, I think, in the next 6 months. I think if you were going to think about I remember the 60-40 portfolio was equities, bonds, and then a sprinkle of gold. I reckon, I don't know if someone can run it, but right now the right trade would be equities, bonds, and a sprinkle of oil calls, because the oil calls will act as a hedge in this environment. Even an hour before our spaces, the Saudis said that they want to investigate the disconnect between physical and paper oil. And, that kind of hinted like they want to tighten the market, not loosen the market. So oil is actually a big factor in this current market and could blow up things. That's why I think maybe the new 60-40 portfolio has a sprinkle of oil calls in there. But, I just want to emphasize the treasuries, is still a safe haven. So, it's down, 20% down on the year? That could reverse in a very bad scenario.
Well, and importantly, it's a relative, right? I keep making this point. When you have these real risk-off periods, the convexity you get from treasuries relative to equities can be enormous. You can make up 2,000, 3,000, 4,000 basis points against the S&P, and that's happened historically when stocks go down and treasuries rally, if that ends up being the right kind of sequence. I want to get to a little bit more of the audience. I know we only have a few minutes left. I apologize. I've been loving this conversation, so I apologize for not having as much of the audience as before. And again, everybody, please make sure that you follow Shrub here on Twitter.
Yeah, I'll just take it easy. I mean, so I think brokers in general, when liquidity dries up, which I think if you need to keep the credit market tickers on your screen. So HYG as an example, or the credit spreads. So what may be bullish for US treasuries is not necessarily bullish for credit. Let's just clarify that. So you could have a bid for treasuries, but a massive puke in credit, which is what happened in 08.
And by the way, I know that's classic risk-off behavior, which is also why this year was strange, because you didn't see spreads widen to the extent that treasuries sold off.
Absolutely. I think spreads are way too tight still given all these things happening. So, some brokers are adjusting accordingly. As regards to the UK high street banks, from my experience, because I used to cover them 15 years ago, it depends on what kind of hedges they have and what liquidity they have. And ultimately, they're kind of short-termist as well in extending credit. So I wouldn't, I would take advantage of them, but I wouldn't read too much into it because that can dry up very quickly as well.
Well, by the way, that goes back to my tweet, which is that inflation is not a monetary phenomenon; it's a leadership phenomenon. Because at the end of the day, who runs the Fed, who runs the ECB? They're people. Same thing with politicians with these asinine policies. It's people that are the problem, right? So anyway,
yeah, I like that.
Let's do one last question, and again, everybody follow Shrub.
Yeah. So I'll just address the oil thing. So the oil headline came out an hour before the Spaces. When I saw it, the first thing I did is I bought calls on oil. I didn't have calls at that point. I used to have calls, and I just bought calls when I saw the headline. It's for me. It's a speculative trade, but I was shocked. I was really, really shocked when I saw the headline because you had the Europeans begging, you had the Americans calling the Saudis, and then with the Xi. What's the first visit that Xi is doing outside China for the first time in 3 years? Saudi Arabia. Oh my God. So that's why I said the 60-40 portfolio, you need to include energy in there, in your mind at least, or somehow in your portfolio, because at the heart of all these things is energy. And the problem with energy right now is that it's been a capital cycle gone bad. Underinvestment for 10 years. They've been investing 50% less every year for the last few years than they should. 50% less every year for the last few years. So energy is at the heart of the problem, and it's not going to get away soon because you can't print energy. And the fact that the Saudis have gotten involved now with that, seeing oil down because of various reasons like SPR and China, all that stuff, China slowing down, I think is very worrying. I think it kind of reinforces all these 10 points that I said, these 10 bad points. Bad point number one, Europe baseload power prices up 15%. US CPI is not going to get better. China is not going to get better with this. So it's a very nasty setup. And that's why it's very helpful to follow people on these spaces like, Alex was on with Michael in the past. And also, Paolo Macro is on this. He's listening now, but you should follow his threads about the physical versus paper. That's a very important distinction.
I sent Paolo a DM because as much as I know there was a little back and forth or tweet around this kind of black swan weekend, let's call it, when I first said it and everyone went after it. Paolo, if you are listening, I'm happy to have you on. I think it would be actually a really interesting conversation. But sure, I'm sorry, go ahead, finish that thought.
Yeah, no, I think Paolo nailed it. And I mean, when Paolo said about the physical versus paper, and, some people were shrugging it off. Well, I mean, you have the Saudis kind of like doing it in a Bloomberg headline. That's a pretty big deal. So I would encourage people to be vigilant. Don't get overly bearish because you can always buy things. You can buy energy, you can buy treasuries if you want if you feel the time is right, whatever. But, you can always buy something. You can always short something. That's why the market is a beautiful place. And, in a bear market, you get so much volatility as well. There's a lot of opportunities for flexible mandates to do well, and also, thematic mandates as well. And, and it's a rotation, right? One thing doesn't work, but the other is going to start working soon. So, be open-minded.
And everybody follow Shrub, and I will do one with Shrub and George Noble, who I know hates that I have to end it here. But everybody, again, thank you for joining, and enjoy the rest of your day. Thank you, Shrub. Do appreciate it.
Thanks, Michael. Take care.